Hello and welcome back to Money Mindset Hub, your home for navigating the world of finance and building a stronger financial future. I'm your host, Raul Sofa. Let me ask you something. Are you thinking about buying a home sometime soon, maybe refinancing? Or perhaps you're just trying to understand where the economy is heading and what it means for your savings and investments. If any of that resonates, you've tuned in to the right episode. Right now, in May 2025, one of the biggest questions swirling around is, what's next for interest rates? We hear about the Federal Reserve, inflation, economic growth. But what does it actually mean for your wallet, especially when it comes to big decisions like buying a house? Over the next 20 minutes, we're going to break it all down. We'll explore the current economic outlook, dive into the latest interest rate forecasts, understand the direct impact on mortgage rates and the housing market, and touch upon what it means for broader economic growth and your investments. No complex jargon, just clear insights to help you make informed decisions. Stick around because understanding this landscape is key to your financial well-being. All right, before we talk forecasts, let's get a snapshot of where we stand right now in mid-May 2025. Think of the economy like the weather. Sometimes it's sunny, sometimes stormy, and usually there are signs telling us what might be coming. Globally, things have been interesting. We've seen varying speeds of recovery across different regions. Europe has been navigating its energy situation and geopolitical factors, while growth in Asia presents a mixed picture. These global trends matter because the world economy is interconnected like a ripple effect. What happens overseas can influence demand for US goods, supply chains, and ultimately sentiment here. Now let's zoom in on the US economy, which often sets the tone globally. In recent months, we've been closely watching two main things: inflation and growth. Inflation, the rate at which prices rise, was a major headline grabber over the past few years. The good news is that we have seen it moderate from those really high peaks. However, the journey back to the Federal Reserve's target, typically around 2%, hasn't been a perfectly straight line. Some months show progress, others show stickiness in certain sectors, like services. As of May 2025, inflation is certainly lower, but the question remains, is it settling comfortably, or could it flare up again? On the growth side, measured by GDP or gross domestic product, the US economy has shown resilience. It's continued to grow, albeit perhaps not at a blockbuster pace. The job market has also been a key indicator. While unemployment remains relatively low, historically, we are paying attention to hiring trends, wage growth, and whether businesses are feeling confident enough to expand. Are companies investing? Are consumers spending? These are the vital signs we're monitoring. So, the picture in May 2025 is one of cautious optimism mixed with vigilance. Growth is happening, inflation is down from its highs, but there are still underlying factors and global uncertainties that keep economists and policymakers on their toes. This context is crucial because it directly influences the decisions made about interest rates. Now let's talk interest rates. When we talk about interest rates in the economic forecast context, we're usually referring to the target range for the federal funds rate set by the US Federal Reserve, or the Fed. Think of the Fed as having a dual mandate: keep inflation in check and maintain maximum sustainable employment. Their main tool, adjusting interest rates. Why do these rates matter so much? When the Fed raises rates, it becomes more expensive for banks to borrow money from each other. They pass those higher costs onto consumers and businesses in the form of higher interest rates on mortgages, car loans, credit cards, and business loans. The goal is to cool down spending and borrowing, which helps fight inflation. Conversely, when they lower rates, borrowing becomes cheaper, encouraging spending and investment to stimulate growth. So, where are rates now in May 2025, and what are the forecasts saying? They've been in a wait-and-see mode, carefully watching the economic data, inflation reports, job numbers, growth figures, to decide their next move. The big question is, what happens next, based on current data and projections circulating among economists as of hypothetical May 2025, Scenario 1 rates hold steady. Many analysts believe the Fed might continue to hold rates at their current level for a while longer, possibly through the summer or even into the fall. They'll want more conclusive evidence that inflation is firmly on a path back to 2% and without significantly damaging the job market. Scenario 2, potential rate cuts. Later in the year, if inflation continues its downward trend and maybe the economy shows signs of slowing more than desired, the discussion could shift towards rate cuts later in 2025 or early 2026. This would be aimed at supporting growth. Scenario 3, an unexpected hike. While less likely based on current trends in our hypothetical May 2025, if inflation were to unexpectedly surge again, the Fed wouldn't hesitate to raise rates further. They've made it clear their primary battle is against inflation. What's the consensus? Right now, the prevailing forecast leans towards rates staying put in the immediate term, with a possibility of cuts later in the year if the data cooperates. But, and this is crucial, forecasts are just educated guesses based on current information. Things can change quickly depending on economic reports or unforeseen global events. The key takeaway here is that the era of rapid rate hikes seems to be behind us, but the path forward is data-dependent. The Fed is signaling patience. Okay, let's bring this down to earth. How does all this Fed talk affect those dreaming of owning a home or those already with a mortgage? There's a direct link, though not always one-to-one. The Fed's rate influences the cost of borrowing for banks, which heavily impacts mortgage rates. When the Fed holds rates steady, mortgage rates tend to stabilize, though they can still fluctuate based on market sentiment, bond yields, specifically the 10-year Treasury yield, and lender competition. As of May 2025, mortgage rates are significantly higher than the ultra-low levels we saw a few years back. They've likely leveled off somewhat following the Fed's pause, assuming this based on the previous segment. But they remain a major factor for affordability. Let's picture a young couple, Maya and Ben. They've been saving diligently for a down payment. A couple of years ago, a $400,000 mortgage might have seemed manageable with lower rates. Today, at current rates, the monthly payment for that same loan amount is considerably higher. This directly impacts how much house they can afford, or even if they can afford to buy right now. This affordability challenge has definitely impacted the housing market. What are we seeing in May 2025? Home sales? Sales volume has likely moderated compared to the frenzy years. Higher rates sidelined some buyers. However, there's still underlying demand, especially from millennials entering peak home buying years. We might be seeing a slower, more balanced market compared to the intense bidding wars of the past. Home prices. Price growth has also slowed significantly. In some areas, prices might have plateaued or even seen slight dips, while others remain resilient due to low inventory. It's become much more location-specific. So, what can potential buyers or homeowners do in this environment? Actionable insight 1. Get pre-approved early. Knowing exactly how much you can borrow at today's rates is crucial. It sets realistic expectations. Actionable insight 2. Shop around for mortgages. Rates can vary between lenders. Don't just go with the first offer. Compare terms and fees. Actionable insight 3. Consider your timeline. If rates do potentially decrease later in the year or next year, refinancing could be an option down the road for those buying now. But don't try to perfectly time the market. Buy when it's right for your life and finances. Actionable insight 4. Factor in the long game. While rates are higher now, home ownership is a long-term investment. Focus on finding a home that meets your needs and budget over time. The mortgage landscape is challenging but not impossible. Understanding the connection between the Fed, interest rates, and your borrowing costs empowers you to navigate it more effectively. While mortgages are a huge focus, interest rate expectations also influence the broader economy and other investments. Higher borrowing costs can make businesses more cautious about expanding or investing in new projects, potentially slowing down overall economic growth. That's the balancing act the Fed manages, cooling inflation without stalling the economy. The current outlook, as of May 2025, suggests moderate growth continuing, supported by consumer spending and a decent job market, but headwinds from higher rates remain. For your investments, savings accounts. Higher interest rates generally mean better returns on high-yield savings accounts and CDs, certificates of deposit. It's a good time to ensure your cash savings are working harder for you. Bonds. Bond yields are influenced by interest rate expectations. When rates are high or expected to fall, bonds can become more attractive. Stocks. Higher rates can be a mixed bag for stocks. They can increase borrowing costs for companies, potentially hurting profits. However, if rates stabilize because the economy is strong, the market can react positively. Actionable insight. 5. Stay diversified and focused long-term. Don't overhaul your entire investment strategy based on short-term rate forecasts. A well-diversified portfolio aligned with your long-term goals, retirement, etc., is designed to weather different economic conditions. Trying to time the market based on Fed moves is notoriously difficult, even for professionals. So, wrapping up our look at the May 2025 landscape, the economic picture shows resilience but requires monitoring, especially regarding inflation. The prevailing interest rate forecast suggests the Fed might hold steady for now, with potential cuts later this year if data permits, but uncertainty remains. For mortgages, this means rates are likely to remain elevated compared to recent lows, impacting affordability and creating a more balanced housing market. And for investors, it reinforces the value of diversification and a long-term perspective. Understanding these dynamics isn't about predicting the future with certainty, it's about being prepared and making informed decisions. Knowledge removes fear and empowers you to take control of your financial journey, no matter the economic climate. What are your thoughts? Are you looking to buy a home soon? How are you navigating the current economic environment? Share your experiences and questions in the comments below. I love hearing from the Money Mindset Hub community. If you found this episode helpful, please give it a like. It really helps the channel reach more people. And if you haven't already, make sure you subscribe to Money Mindset Hub and hit that notification bell so you don't miss our future episodes on building wealth and mastering your finances. Thanks for tuning in. Remember, building a strong financial future starts with understanding the present. I'm Raul Sofa, and I'll see you in the next episode.